Hello and welcome to the ResMed Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Dion, welcome to the show.
Thank you, Owen.
It's good to chat with someone who had to come about 25 metres to come into the studio, a fellow Melburnian mate. So it's my pleasure to have you with us. So we're going to talk about X20. We're going to talk about the strategy that you manage, about the Yarra Capital business, a bit about your background, and then we're going to dive into three companies that are really interesting to me, being ResMed, Car Sales, and NextDC. And I'm sure 95% of the people that listen to this know those three businesses, or at least know a little bit about them. I usually start off with a couple of icebreakers, mate. And two I've been asking recently, bookends. So the first one is, what's an investment that you have personally made recently?
I'd say the last sort of substantial personal investment I've made, and my comments are going to sound quite predictable, is actually into one of Yarra's funds.
Okay.
Look, I back the team, back the talent, back the opportunities we pursue, and it was the Yarra Private Capital Fund, which really focuses on pre-IPO companies. Look, just a few observations to share. The IPO market's been virtually shut for 3 years. There's a wall of companies that need capital, thought they were going public, they're not able to go public. And in some respects, the team's got the ability to pick through the eyes of that marketplace, secure good deals on great terms, and it's where patient capital gets rewarded. It's one of those many places in Australia where there's just a ton of inefficiency. So that's sort of my last substantial private investment.
That's great. I really like that. And a really interesting answer. No one said that and identified that on the show before. The second one, so if that was the most recent, let's go back to the other side of the bookshelf. What was the first investment that you made?
Yeah, look, it's fair to say I'm a complete stock junkie and have been since I was a kid, probably one of those sort of cliche investors. My first investment, I was 12. It was a WA-based gold mine company. It ended in tears. And, you know, at 12, you don't know a lot, but what I did see was a hot tip in one of the newspapers that said it was going to be the next big gold company. And a lot of lessons learned from that experience, one of which is capital's not guaranteed, second of which is never rely upon hot tips in newspapers. By the time something's in a newspaper, it's typically either too late or it's frankly wrong or it's a consensus view. But in some respects, that's when I got the bug. And you could argue it's sort of uphill or downhill from there, but I've been investing ever since.
Yeah, great. I love that. A great answer too. 12 is a heck of a young age to start in listed companies. Yeah. Okay, so this is your first time on the show, and what I like to do with first-time guests, and it probably would be the first of many, but it's just to understand a bit more about your background. And you can start this wherever you want. But what I'd be really interested in is like up until the period of Yarra and then why Yarra, if that makes sense. So let's start with you. Where did that journey start and take us through?
Sure. Well, I'll avoid the conversation around kindergarten and prep because it's not interesting to anybody. I guess my professional career started at the Boston Consulting Group, a BCG global strategic consulting firm. It was a window into a world. And recognizing in the background, I was always a stock junkie, and investing and following markets sort of ran through my veins. But BCG was a great way to get formal analytical experience, to understand businesses, to try to solve problems, to work with some brilliant people, and to see a broad range of industries in a reasonably short period of time. So after about 3 years at BCG, I decided to sort of, in some respects, follow my passions, which was to go into investing. Long story short, ended up moving to the US. Was super fortunate to be working at Fidelity in the early 2000s, just as the tech bubble was bursting. And in some respects, that was one of those sort of pinnacle opportunities. It was it probably still is one of the preeminent research houses in the world, one of the largest pools of capital, in some respects, one of the homes of sort of bottom-up stock picking and fundamental analysis. And that was a brilliant place to start formally an investment career. And, you know, a lot of what you do in investing is you accumulate experience, scar tissues, and make mistakes along the way. But just seeing that tech bubble burst, and frankly then subsequently seeing emerging markets crises along the way, is something you carry with you. And I think it's a healthy discipline, in some respects, a healthy skepticism, which any sort of objective investor needs to carry each and every day. So after a few years at Fidelity in Boston, which I thoroughly loved, was offered the chance to go join Citadel, which is probably one of the world's largest hedge funds today. Brilliant organization, unbelievable long-term track record, interesting and complicated organization, but a place that probably had, in my in many respects, sort of a preeminent focus on portfolio construction, discipline, and really just having an information edge. And in some respects, I was there for 2 years, but it felt like a lot longer than that. I was doing global equities, mostly industrials and tech. And that, again, awesome learning experience surrounded by some absolute brilliant people. Then decided to move back to Australia and joined Goldman Sachs Asset Management for the better part of a decade. And, I was very fortunate to join a business that was pretty close to the ground floor. We were able to assemble what's been a fantastic team that have largely worked together for the better part of 16 years. Mm-hmm. And in some respects, we got to draw upon a lot of the experiences we'd had at prior organizations, how you want to invest, how you think about markets, how you think about companies. And, the team and the organisation with Goldman's support built a strong track record and a franchise over the better part of a decade. There's certainly a lot you take from working at Goldman Sachs in terms of the importance of culture, talent, teamwork, the disciplines, the work ethic. And that's something that served us well for the better part of a decade. And then, look, an opportunity frankly presented itself to lead a management buyout of what was a big part of Goldman Sachs Asset Management to become an independent funds management company. And look, we took a view, and I think time would suggest we have been vindicated on that view, that the best way to run an asset management business like this is to be independent, to be focused, to be a pure play, to be co-owned by the lead members of the executive team and the investment team, and to set up our own franchise. So in some respects, setting up Yarra in 2017 wasn't a greenfield. It was lifting and shifting quite a formidable business that was there at Goldman Sachs, and being able to draw upon experiences that I'd had over preceding decades and some of my other colleagues. So we're 7 years into the business, super pleased with how it's going, and also very fortunate given sort of the lineage and the pedigree that we've had working at different organisations.
Your background is fascinating in terms of, if you think about the way you illustrated it there, is like the different lenses at which you would develop an investment strategy.
Yeah.
Thinking in terms of like strategy and these types of things. And then that was cultivated through consulting work, and then going bottom up with arguably one of the world leading firms in that respect.
Yeah.
And then saying, well, how do we combine that with that? And then look across a portfolio, like in terms of breadth, and then coming back and honing that craft for so long. For folks that, if I could just double click on one thing, which is the transition from Goldman to Yarra.
Yeah.
You mentioned there like a management buyout. How does that actually take place? Like what actually happened to you, and why did you see that as a great opportunity? You said independence, but if you could elaborate on that process, that'd be great.
Yeah, look, Goldman's a wonderful organisation, but it's global. It's got multiple business units. Asset management is but one of them, and equities, let alone equities within Australia, is a relatively small part. So we're a small part of a massive franchise. And I think that the view was that on behalf of our clients, our staff, and the leaders of the business, we'd be a stronger business long term, and we could invest in our own business the way we invest in public companies if we were focused and if we were independent. So in some respects, it was a seismic change, going from a 35,000 person organisation to what was literally a 35 person brownfield build of an asset management company. Some things were seismic changes, some things were subtle. We kept the same funds, we kept the same investment process, we kept the same investment teams. We literally stayed in the same office building, but we did it in an independent and focused way.
That's great. How much capital does Yarra manage today?
Yeah, ballpark, it's around $20 billion.
Wow.
And we've never considered assets under management as a proxy for success. All that tells you is size. We know that successful asset management businesses are led with returns. So for us, it's about generating strong risk-adjusted returns for our clients, having products that are relevant today and relevant for the future. And our view is if we do that right, the assets and the financial outcomes, the outcomes for staff development and team development will naturally follow.
I want to talk to you about the X-20 Fund in particular, because as I was saying off air, this is really interesting to me in our community right now. Is obviously people are really familiar with the Aussie banks, the miners, the big supermarkets. We've got a top-heavy market, it's narrow. And so people naturally want to look outside of that. Can you walk us through, and you could take this through like in tandem as this is like the Yarra Capital way, or maybe you can take it in the sense of this is just one of the strategies that we offer. But I'm curious if you can talk to us about your investment philosophy, and then we'll roll into why we look in this part of the market?
Well, if you don't mind, I might start with the logic behind X20.
Sure.
And then we can probably take the conversation into who we are and how we invest. Start by really actively questioning the benchmark that most people default to, the ASX 200 or 300. And what's blatantly obvious to me when you stare at it is to the extent you were ever going to create a benchmark, you would never create one like the ASX 200. It is fatally flawed in its composition. And if you think about the hallmarks of strong investment returns over time, it's about diversification, it's about having choice, it's about making active decisions. Well, all of that gets clogged when you've probably got one of the world's most concentrated benchmarks. So a few sort of broad numbers to share with people. Everyone defaults to the ASX 200, and when you ask people why, you rarely get a great answer. And when you ask people, what else do you do? They say, well, we have a small cap fund to complement it. In some respects, they've been the barbells that have been ingrained in most people's portfolios. Yet very few people have actively questioned why and is it a logical composition. If you focus for a moment on the ASX 200, what becomes obvious is the 20 biggest companies, most of which are mature, most of which are subject to sort of macro influence as opposed to individual business outcomes and micro opportunities. 20 biggest companies are circa 65% of the market. It is one of the most concentrated markets in the world. And if you break that down further, 7 companies represent about 35% of the market. And those 7 companies are the big 4 banks, which a lot of people default to investing to just because they're part of benchmarks. And another 15% is the iron ore miners. So we often talk to our clients about the fact that to the extent that the US has got the Magnificent Seven, which has driven up earnings, it's driven up valuations, driven up the S&P, our 7 largest companies in equivalent terms are 4 banks that are very mature. They are highly correlated. You know, those businesses used to have different business plans, strategies, execution. Now you've got 4 banks that are largely doing the same thing. And then you've got 3 companies which you might think of them as diversified miners, but when you pull apart their economics, it's pretty much just iron ore. Iron ore is the vast majority of revenue and profits of BHP, Fortescue, and Rio. So the logic here is to say the best opportunities you'll probably find, in my opinion, are the ones outside the biggest 20 companies. That's the remaining 35% of the market. And what you find is they're less efficiently covered. By the time you get to be a mid-cap in Australia, and that's mostly what we're thinking about, you tend to have a proven business model. Very often you've got an offshore growth opportunity. You've de-risked as an organisation. You're not brutally efficient. The last time we checked it, there are about 30 sell-side analysts that cover BHP. And good luck having an edge on a quarterly result for BHP when the whole world's combing over it. So our view is if you think about it logically, we have thought for some time the sweet spot of investing is probably outside the 20 biggest companies. When you look at the historical data on this over a 5, 10, 20-year time period, what you'll see is the strongest returns have actually come from mid-caps. They've been on average about 300 basis points stronger than small-cap investing because it's a lower risk profile, it's still liquid, and there are plenty of vibrant opportunities there. So our view is actively question why people default to the 200 biggest companies. The sweet spot's probably outside of that. And then it's about coupling that with an active manager that you trust and you believe their judgment's sound to pursue that opportunity.
What are maybe we'll get to some of these companies in a second, but you mentioned there about like the mid-caps outperforming. I'm curious because I looked at CBA's earnings per share in the past 10 years just this week, and I realized over 10 years earnings per share are up like 12, 13% in 10 years, which is like anemic. Like you're not, what are you getting? And what we have seen is a massive valuation expansion. But the problem, if I could say, the problem that people will have is like it's performed well over time through that valuation expansion. Do you think that maybe that is not sustainable? That like stretching PE ratios, stretching valuations? I
think it's a good observation. As far as investors go, we're kind of old-fashioned. We believe earnings and cash flow drive long-term returns. They facilitate dividends, they compound, and it's the basis for making money. What's really interesting about the banking sector is the earnings for the sector peaked in 2016. The absolute levels of earnings are lower today than what they were 8 years ago. Coincidentally, 2016 was the year before the Royal Commission into banking. So obviously, it did have a lasting effect. Your observation's a good one. CBA's earnings growth cumulative over a decade's been anemic at best. And I'd point out that's the best of the 4 banks. So what you've seen in the last 12 months has been a real anomaly for banks is, broadly speaking, their earnings were lower in fiscal 24. Their price to earnings ratios expanded by 30 to 35%, which we probably feel is not sustainable. And if anything, that introduces the risk of devaluation into the future. So if the earnings were driving these stocks, it could easily readily be explained. They're not. There's a whole lot of, frankly, non-fundamental factors that appear to be pushing up bank valuations. And as an active stock picker, that's the opportunity.
Yeah. Oh, yeah. What's interesting about that too is, so we talk about earnings. Obviously, dividends to be sustainable over the long term are paid from earnings, not paid from financing and refinancing debt or whatever. And if you think about that as a yield-focused investor, even if you say, well, mature companies yield-focused, you still want a growing dividend because you've got purchasing power to think about. You've got all those other things, right?
Yeah, we're in a really unusual environment that a lot of investors probably haven't seen for a while, which is it's the first time in 12 years you get a higher yield on a term deposit than the Australian stock market. So my simple counsel to people is if you want yield, go somewhere else. Like don't buy blue chip Aussie companies for yield. Because you can get better yield in a private credit fund if you're careful. You can get it in a TD. You do get some benefits from franking credits and listed companies, but you don't go there for the dividends. You go there for the total return. And the way you get the total return is the combination of dividends, earnings growth, and then valuation appreciation. And I guess what we'd point to is the 20 biggest stocks have got very limited growth.
So we're excluding that, I think you said 65% of the market, which is those top 20. When you're left with your universe below that, what is the broad composition? So obviously we're top heavy with miners and banks, but what happens when you go down to that level? If you take that universe, what's kind of the sector breakdown? You don't have to be specific, but just generally speaking, what do you see?
I'll talk in broad terms. What you've got, and this is important as investors, you've got a more fragmented benchmark. It's not concentrated around 7 companies or 20 companies. You've literally got the next 280 companies. And no stock is more than 3% of that benchmark. In contrast to the ASX-200, there's a few stocks that are over 10% of the benchmark. But when you look at it through a sector lens, what you find is the banks have gone from being the most important sector to an irrelevant sector. There's 2 regional banks. They're tiny in the X20 part of the benchmark. So in my opinion, that's a good thing for long-term growth. You've got similar exposure to resources, but it's not dominated by one commodity. So large cap resources is dominated by iron ore, which we have our doubts about, given we feel like we've seen peak steel, ton of iron ore supply coming on, lower prices into the future. So there you've got equivalent exposure to metals and mining. You've got a far more interesting suite of commodities to invest in, whether or not there's more exposure to copper, to the extent you ever want nickel. There's oil and gas. There is mineral sands. There's rare earths. There's lithium. So you're spoiled for choice once you move outside the 20. Then you've actually got larger exposure to REITs, which, given where we are today, I think is more of a curse than a blessing, but we can talk through that later on. And you've got greater exposure to industrials. So the better part of this is you've got a lot more choice. You've got a lot more companies that have got higher growth potential because they're not mature. They're not beholden to what China's GDP numbers are or credit growth in Australia. And you've got companies with largely proven business models. Now, that's not to say you want to own all 280 of them. We actually have the contrary view. We research 280 of them and we buy 10 to 15% of what we look at.
Yeah. Would you say that there are – so you mentioned one before actually, which was quite interesting about yield and term deposits and that kind of trade-off right now, the anomaly, if you like. Do you think there are any misconceptions about what's outside the 20 in Australia? Like, when I speak to a lot of investors, particularly older investors, I don't want to throw them under the bus here, but they do lean heavily into their CBOs, their CSLs, because those are the ones that they've known since the 90s have outperformed and whatever. Are there any misconceptions about what you get outside of the top 20?
Yeah, I think if anything, there's a perception that it's risky. And that perception might be valid for small caps or for micro caps, not to say you don't want to be taking that risk. But what you've actually got is a lot of household names and frankly proven names. You look through some of the names that are in the X20, not to say you want to own all of them, but what have you got? You've got you did have James Hardy that's been promoted. You've got Stockland, you've got ResMed, you've got car sales, you've got NextDC stocks we might talk a bit later on. They're big household names, they're proven business models. And frankly, they're just not as mature as some of the 20 largest companies. So I think there is a bit of a misperception. When you roll from a large cap benchmark to an X20 benchmark, you do give up a little bit of yield, but frankly, we feel like you pick up a lot of extra growth potential and the trade-off's positive.
So the general theme for the next 3 companies we want to talk about is like structurally growing companies, which is kind of flying in the face of the maybe not structural decline, but structural plateau of, say, the banks, let's say. But before we get to those three, and we'll go through them one at a time, is that a prerequisite for companies making their way into the portfolio? Do you and your team go, okay, well, we've got that 280, let's refine it, and then we want these like undercurrents of a structural growth thematic? Is that a requirement?
Yeah, it's not a requirement, but it certainly helps. I mean, frankly, long-term returns tend to get generated through earnings growth and cash flow growth. So that's the first point. If you look at the historical returns of the Australian market, literally half the returns have come from dividends, half have come from capital appreciation. Now, capital appreciation is more likely to come from when you can get it in one of two ways. Either your PE multiple, I'm simplifying things, expands, or your earnings grow. And we're not in the business of predicting PEs. What we are in the business of doing is forecasting earnings over long periods of time. So we certainly prefer businesses with structural growth, but I think you need to be careful. You don't buy everything that's growing. And what we always say to as a team is you need to be careful. Great companies, not always great opportunities.
Yep.
There's this view to buy quality stock at any price, and I think that's an easy way to get hurt. What we would point to is you'd like to have structural growth. You need to be buying those businesses with an inefficiency at sensible prices. But to give you a contrast that's also a theme that runs through our portfolios is we own plenty of quality cyclical businesses where, they haven't grown much over time, but we might be buying them at the bottom of the cycle. We might be buying them on a depressed valuation. We might be buying them after they've had a misstep. Extraordinary returns can be made from that way. Our approach to investing is we're pretty much style neutral. Our view is let's pick the best opportunities. I don't care if it's high growth or low growth. What we do care about as a team is it's a quality business, good industry structure, sensible balance sheet, and there's the foundations to grow capital.
The first company that all makes sense to me, but the first company that we want to talk about is ResMed, which until maybe say 18 months, 2 years ago, was considered like one of the darlings of the market. It still is, to be honest. In my mind, it still is. But first, the rhetoric around it was there's some changes that may happen. There may be a competing technology, which we can get to in a minute. But for folks that aren't familiar with the business, can you give us like the bird's eye view of ResMed, why you like it, and then we'll flow from there?
Yeah, look, in simple terms, they make sleep apnea devices. And sleep apnea is something which, on industry estimates, circa 20% of the world's population actually suffers from. In simple terms, it means you're choking when you're sleeping. And you're more likely to have sleep apnea if you're overweight. You're more likely to have sleep apnea if you're born with certain defects, or if you've got what's referred to as comorbidities. You've got other diseases that are likely to cause it. And what you'd find, and this is why I think it's got awesome structural growth as a business, is you start with a view that there's this massive unmet need. Then you work on the industry structure and you say, well, there's only one or two meaningful competitors. And by the way, ResMed probably does have the best intellectual property, brand and product. And then what you've got is a series of drivers that are forcing both the market to grow and that penetration to grow with it. So CSL's been a market darling in Australia, and deservedly it has had that status. The last 5 years haven't been kind from a earnings growth perspective or a capital appreciation perspective. But in some respects, ResMed's the business that's always been in its shadow. But when you look at the fundamentals, they're as strong or stronger. And we feel it's a really inefficient business. And we can see a decade of growth in front of that business. What you often see is Australia's a relatively small market. We're talking about mid caps. It's easy for these businesses to get knocked around by sentiment and what we'll refer to as non-fundamental factors. And I think, all the dislocation that's happened around these GLP-1 drugs or alternative therapies has caused, a super high quality business to go on sale. And it's a stock that we've probably owned for the better part of a decade. And all the hysteria in the last 12 months has just given us an opportunity to own more of it.
Yeah, right. In terms of that was going to be one of the questions that I have is let's go straight to the perceived elephant in the room, which is the GLP-1s, commonly called in some circles Ozempic is probably the lead product that people know. People are familiar that, largely with what they do around helping people with diabetes, but also helping people with weight loss.
Yep.
And the derivative of that belief is that maybe that means fewer people are obese, in which case less need for ResMed devices because they're not suffering from sleep apnea. Feel free to pull apart that logic.
Yep.
We can just start from there, I guess.
Yeah, I'll start with the obvious caveat that I'm not a medical professional.
Yeah, neither.
Or a researcher. Yep. But I'll share with you some of the research our team's undertaken. One of which is these GLP-1 drugs are miracle drugs. They've been used for type 2 diabetes for decades. and they have really considerable benefits. What's happened more recently is they've almost become a consumer luxury good where they're being used for people from a weight management perspective. And I guess the way that some people have thought about it is if you lose a ton of weight, and the average person who does go on a GLP after 12 months loses about 20% of their weight. So that's one important statistic. If you do lose 20% of your weight, possibly you don't need a sleep apnea device. That is the logic, and it's rather tenuous logic that many people are using. And it's being ResMed's being branded as a GLP loser. And I think we challenge big parts of that research, and we challenge it based upon what we deem the facts to be. One of which is, and these statistics are alarming but true, approximately 60% of the US population is obese or morbidly obese. And before you sort of cast too much judgment on America, I think Australia is the second most obese country in the world, so we're not far behind it. But what you'd probably find is that there's a lot of people that have got sleep apnea. It's undiagnosed. If they do want to get prescriptions for GLP-1 drugs, they actually have to go to physicians. They have to be prescribed these drugs. And they're most likely to be prescribed those drugs, and I'll talk about access to those drugs in a moment, in conjunction with a sleep apnea device. Because the reality is you might lose 20% of your weight, but that is over a 12-month time period. If you're choking every night now, you can't exactly wait 12 months for that to actually be cured. And what you're finding is it's probably being used as a complement rather than an alternative to the use of GLP-1s. GLP-1s are also a luxury good. So the extent you don't get medical reimbursement, and outside of type 2 diabetes in the US, you don't really get medical reimbursement. They're about $1,000 US a month, which only a small proportion of the US population can actually afford. And they do have quite meaningful side effects. Now, if you're a sick person, those side effects might be manageable. But if you're a healthy, overweight person, you might find that be overbearing. So what you're finding is after 12 months, about 60% of people who started on these GLP-1s have stopped using them. And when they stop using them, the research would suggest they're actually putting on all of the weight they actually lost. So unless you're on these therapies for life, there is no ongoing benefit. But what we can also say is based upon a lot of data sets that are readily available, and this is what happens with, you can see this through ResMed, is people that get diagnosed with them probably get diagnosed with a sleep apnea device at the same time. They're more likely than an average person to use one of these devices, and they use the masks more often and need more replacements. So we feel that this is a widely held urban myth that they're a loser associated with this. Even if the market does shrink over time because less people are overweight, such a low level of penetration. And what you've got, in my opinion, is a brilliant business at a distressed price.
Yeah, it's fascinating. I actually was talking to someone the other day that has what you would say is like comorbidity, and they were prescribed GLP-1 for weight loss to help with other things that they were experiencing. And I said to her, have you started yet? And she said, well, I can't get it because there's not enough to go around. So obviously, and I said, well, is it expensive? And she was like, yeah, it's very expensive. And I obviously, well, not obviously, but I don't you have a need for these types of things. But I can see how it's bringing awareness to the sector. And I remember looking at the original research on the original products that came out for weight loss, and the sample and the studies, you could find flaws in those studies, as in not being a medical professional myself, but I could see the sample that they were using, the results and the side effects that many people experienced, and how that, in my opinion, would relate to ResMed is the market is enormous and still underpenetrated. So I think, personally, I think it's a wonderful business. I did have one question, if we could invert the logic just for a moment before we move on, which is when it comes to a business like this, and feel free, you don't have to use ResMed as this example, but I thought this might be an interesting way to demonstrate this, is how would you know if you are wrong?
Sure. I mean, the only way you know you're wrong, firstly, is by being open-minded. And we sort of pride ourselves, share price correcting could be another signal, but we sort of pride ourselves on being, as a team, just dispassionate, very objective, to challenge our own thinking and challenge our own logic. The way we believe we often find we're wrong, and we're wrong more. We often say the only certainty in our business is you'll make mistakes. But what we hope separates us is that we spot them earlier than others, and our portfolios are liquid and we can actually get out of the way. So it almost starts with having an audit trail for why did you invest? What was your thesis? What are the catalysts? What do you think it's worth? What's the timeline? And in some respects, that becomes a checklist.
Yep.
And if the facts aren't supportive or the facts actually change, you just go back to first principles and say, look, if I didn't own this today, would I be buying it? And if the answer is no, well, then it frankly shouldn't be in your portfolios. So that's how we sort of do it. I think the way we also do it is by having a large team, by having some very active debate amongst the team, keeps everyone intellectually honest. I mean, one of the fatal flaws for many investors is what's often referred to as cognitive dissonance, which is you ignore the data points that aren't convenient, you focus on the ones that do support your views, and you can get buried in that logic.
For sure. Another business that it maybe even surprises people because it is such a household name that it's not in the top 20 is car sales. Carsales.com, the business. I've had lots of experience over the years with this website and the app and even boat sales and all the other different types of sales-related websites and marketplaces. But for folks that aren't familiar, can you just explain the model, the business model, and we'll flow from there?
Yeah. So it's an investment we've had probably for the better part of a decade. And it's one of those awesome businesses that we feel just keeps compounding. And there's been a perception that it's mature and there's nowhere to go because it is a household name, as you referred to, and we really disagree with that notion. What is the business? The business effectively is a marketplace. So it's a marketplace that connects buyers and sellers of cars. Sellers of cars could be dealers or they could be individuals, and it could be a consumer-to-consumer transaction. And it started off probably in the same ilk as Seek and REA, where it was a marketplace and you put up an ad and it was a little bit better than a newspaper ad. And as things got digitized, they were the first winner. What's obviously happened since is they've added enormous value to all parts of the value chain. You know, whether or not you're a buyer of a car, there's more information, there's more access. It's now a national, not a local marketplace. And if you're a seller and you're a dealer, it connects you through to buyers faster. It helps you move your inventory quicker, gives you much greater visibility on price discovery as well. Same to be said for a private seller. So what it is it's a household name. It is got dominant levels of market share in Australia, which you don't take for granted. But what it is it's actually in quite a narrow part of the value chain. And the single biggest opportunity for car sales, before we talk about international, I'll talk about that in a moment, is you go from just being the ad to possibly being the verification, to possibly being the finance, to probably being, the way you transfer money. And as you move across the value chain, it stands to reason you're adding more value for the people you're working with, and you can charge a whole lot more. So we feel the business has the sort of unique combination of being entrenched but not mature. And then what they've done in a very sort of measured and sensible way is they've had a playbook that's worked well in Australia. And unlike most other Australian companies that do big bang acquisitions and try to impose a model that's worked here, and we often make the joke, there's a graveyard full of Australian companies who thought they could export their ideas to other countries. Companies to countries, I should say. What I'd point to is they've gone in a slow, measured way. They've been very targeted in terms of which countries and which channels make sense. And it stands today that probably half their business is outside Australia. And they've got a really interesting foothold in Korea, in Brazil, and in the US market, but not for cars, for recreational vehicles and water sports and trucks. So we think it's a really interesting, well-run business. Yeah.
I always find it interesting with REA and car sales, even Seek, they talk about this idea of yield and increasing the yield, and maybe the common tongue would be prices going up. But as you say, like if they create more value, they have, in effect, an entitlement to capture more value and everyone wins. Do you ever worry about businesses like, say, Facebook Marketplace or like those types of communities popping up, Gumtree, those types of things?
Yeah, I think a lot of it got to the heart of your question, which is, this is what we're obsessive about as we think about businesses, is what's the value in use? How much value are they creating? Businesses can get lazy and take price, and they tend to get caught out. Businesses that create more value, they might only take a set percentage of that value, but you can see that's how you can grow revenue and that's how you can grow yield over time. That's been the story for car sales. Look, there's been a wall of formidable global companies that have come into Australia with a view they could displace car sales. And you don't take anything for granted, but I remember people were very alarmed when eBay Motors set up in Australia, and they were very alarmed when Fairfax revamped their car classified business. You don't take anything for granted, but what you would say is it's the core business for car sales. They've got decades of intellectual property. They've got a huge installed base, and they've had to deal with low-cost left-field competitors for decades. So Gumtree has basically free car ads. eBay's, unless you sell the car, the ads are pretty much free. And they've continued to innovate and they've prospered on the basis of that. So Facebook Marketplace has been around for decades. I shouldn't say decades, probably a decade. It is an alternative, but frankly, it's not a vibrant alternative.
Yeah, I find that people still trust the car sales name and they trust the business, and it feels like you better get a higher quality of buyer if you're selling, and you get a higher quality of sale if you're a buyer. And that we see that in many other industries as well, where there's distinct businesses playing at different levels of the ecosystem. The final company that I am really pleased that we're going to talk about is NextDC. This is a business in terms of ResMed. We can describe it pretty easily as like CPAP machines help people with sleep apnea, car sales, buy and sell automotive with an international arm as well, as you said. But NextDC is a slightly different business in terms of people's understanding of the product. So can you talk to us, how do you describe this to clients that invest with you? And then I've got a few questions around the back of this.
Sure. Look, it's a company we've got to know well over the years. In fact, we've been investing in it since 2015. So it's been a really good investment for our clients, thankfully. And we've still got conviction today, and the stock's probably up 5 or 6-fold from where we started. Start with the most obvious observation that it's probably not a technology company. It's actually an infrastructure company. It is broadly confused. I often think the closest parallel for if and when NextDC does mature is probably something like a Transurban.
Yeah, right.
Where effectively you have local monopolies. So there are alternatives, but they behave like local monopolies. You've got a high level of predictability. You've got very strong returns, and your business sort of grows with inflation. What's unusual is, the growth of the data center industry has been extraordinary. And although AI is unbelievably fashionable and it's unquestionably a catalyst for this, there are two major drivers that often get forgotten for why this is a high growth industry that predates AI coming into fashion. First of which is corporations have moved from having their own individual data centers to shared data centers and shared clouds. For the simple reason it's more flexible, it's more cost efficient, and it's proving to be far more secure than having your own data center. So the first wave of growth, which is still ongoing, is moving from individual data centers to co-located data centers. The second wave of growth, which I think is equally profound, and we've only got to look at our own behavior and how we use our phones or our desktops, is we're doing more things and we're consuming more data. And I don't know the exact number, but maybe annual data consumption is 40, 50, 100% a year growth. That leads to extraordinary demand for data centers. And the next wave of demand, which people are getting very excited about, is obviously AI. And at the moment, there's a lot of long-range predictions, and it's hard to put any degree of accuracy on those predictions. What you can say, though, and it's pretty simplistic, is if you do an AI search on Google or any other search engine, it uses about 9 times the amount of data as a simple search. So as we go from conventional search to any other form of AI, it chews through data. You need more data centers. So NextDC for us is interesting because it's a business which, and they're not alone, there's a lot of other high growth data centers, has probably got line of sight on growing the size of its business between 10 to 15-fold from here. Now, a lot of that's embedded in the expectations for the stock, but I can't think of many other businesses in Australia where their level of activity or their volume could grow 10-fold over the better part of a decade. And that makes it, with good returns, by the way, and that makes it really interesting to us.
I saw a presentation a few months ago that showed the usage of data from humans on the internet, looking at cat videos, doing whatever, and then the estimated proportion or volume that comes from B2B applications or technology talking to technology. And that has greatly surpassed what the human effect is. And you talked about it there, like you're effectively tasking the GPT or the AI to go and find something for you. Well, it's going to search and it's going to use a lot of the internet to find your answer versus you manually going through something, which is a very different experience. One of the things that I am curious about is with NextDC being, like you said, an infrastructure business, is typically in those infrastructure businesses, as you referenced Transurban before, is like they require a lot of financial leverage to get what they need to do. And if you're going to 10 or 15x the business, how does the economics of this stack up? Like, how do you get comfort knowing that it's going to be profitable, it's going to spit out cash?
Yeah, so that's really the central question. These are capital-thirsty businesses, so it raises the question, do you get high returns on capital, and will those high returns persist?
Yep.
The data center industry appears to be one where you get both really good returns on capital, a really high degree of persistency. You tend to get really good counterparties, so your large clients could be Microsoft, Google, could be Amazon. But in some respects, a capital-thirsty business, if it's generating good returns, is a great business to be in, because you can put more and more capital to work at well above your cost of capital. I know that sounds quite theoretical. What you don't want is a capital-thirsty business with horrible returns. So, if you look at the history of NextDC, they've probably had to raise equity every 12 months, but they've done that with a clear lens on where it's going and what returns you should expect. And that's served investors well over time. But you're right, there is leverage in the business. The business does carry debt in the same way that a toll road should carry debt, and we're very comfortable with that.
How about in terms of, I guess the question is, like, in terms of management and capital allocation, this is an interesting, it's not necessarily specific to NextDC, but just how you think about that, generally speaking. Your team, I'm assuming, is really keen on this idea of, well, what is the management team doing? How do we get comfort in that? And so the question is, like, how do you get comfort in management and making the right decisions and what they're saying to you stacking up?
Yeah, if I start by sort of back testing, circa 15 years or 20 years of investing in Australia, what I can say categorically is some of our biggest mistakes have been backing weak management teams.
Right.
If your business is an A quality business, you might be able to put up with a B or a C. But if you're a C quality business and you've got a C quality management team, I wish you well with that, because it's going to be tough. So how do we evaluate management? Obviously, there's words, there's actions, there's track records, there's references. So we often talk about sort of a mosaic of data points. There's no one data point uniquely should influence your thinking, but you talk to employees, ex-employees, you talk to suppliers. You look at what companies say, you look at what they actually do, you look at their ability to scale, you look at the quality of their boards, and it helps to form a view on management teams. And, the best views we've formed on management teams tend to be the ones we've formed over time. It's pretty rare you'll ever see a CEO of a public company who is not optimistic about the prospects of their own business. It's pretty rare that you get to be a CEO if you're not a good communicator. So, words aren't enough. What you've got to actually look at is the strategy and the substance.
And for many people will be familiar, the founder of NextDC is find out anything you want to know online, because it's pretty impressive track record is what I would say. Okay, so I've got two more questions for you. The one is, at the start of this show, we spent a lot of time talking about the top 20, and this is just to kind of loop back through that after we've spoken about these companies, is if people are sitting here listening to this today, as I'm someone who has been thinking this as well, what does the next 5, 10, 20 years of the Australian stock market look like in your eyes, in terms of, like, if we take it through the X20 landscape or the plus 20 versus X20, whatever, how do you think that evolves from here?
I'll put it in the simple terms that probably even I can understand, which is you put $1 into a passive fund, for argument's sake. My comments are going to sound self-serving, but passive funds are momentum funds. The bigger a company is, the more money you put into it, as opposed to the opportunity is better, you put more money into it. But the simple lens is, I'll use rough numbers. Every time you put $1 into a passive ASX-200 fund or an active fund with a low level of tracking error, which has got similar characteristics, about 20 cents in every dollar is going to 4 banks. And as we said before, we think the valuations are elevated, the businesses aren't growing, and there could be meaningful downside over the next 3 to 5 years. The next 15 cents goes into those 3 iron ore companies, which, as I said before, if we've seen peak iron ore, that might not be pretty. So I think as you think about what's the future for the largest companies, I've sort of described there, half the ASX-20, I think, could have a tough few years in front of them. They're not collapsing, they're not disappearing, but we could actually be seeing lower returns in the future. The other half of that 20 has got some good businesses in there. Transurban is one of those businesses, but they're pretty mature, and very often they're beholden to the economic cycle. And our view is the Australian economy is going to be a grind. We've avoided a recession, but let's not confuse that with prosperity. There's still a lot of headwinds for our economy. So, which is why, as much as we possibly can, we want to find the parts of the market where we're not reliant on interest rate cuts. We're not reliant on what a GDP number is or what trade relationships with China are like. We're just trying to find good businesses at compelling opportunities where the earnings can grow, as I said, because that's probably the single best predictor for long-term capital appreciation.
Fair enough. I'll put some links in the show notes for anyone that's listening or watching this, where they can go to the Yarra Capital website. They can look at the latest, updates and disclosures of the portfolios and see some of the commentary around additions, subtractions, and those types of things, which you guys routinely put out. Is there anywhere else that you would direct people to learn more about the business?
I'll learn more about Yarra. Look, we put out inside pieces. Well, again, my comments are going to sound pretty biased and self-serving, but we've got a great economist and strategist in Tim Toohey. We've got a wonderful fixed income team. And they periodically, rather than talk about what happened this month or this quarter, they put out thought pieces, which talks about where we see opportunities, where we see risks, how we're thinking about the market differently. And often that's a great way to get a better understanding of who we are and how we operate. But look, we're pretty fortunate. We've got a large research team and we've got close to 30 people researching Australian public companies, whether or not that's the debt, the equity or the hybrids. And we've got a team that I think does thousands of meetings a year and learns a lot from it. And that's what helps shapes our thinking.
Great. Well, there'll be plenty of that available on the website. So please go ahead and check that out. Final question that I have for you is probably the hardest one. I put it to everyone that's the first timer on the show, which is if you could go back and tell your younger self one thing, whether it's about money, finance, investing, it could even be life. Like if you want to get philosophical, feel free. But if you could tell yourself one thing, what would it be?
I'll probably focus on investing, which is to dial down the short-term noise and to not be beholden or unduly influenced by the day-to-day variations of stocks or markets or bond yields. And frankly, and we strive to do this every day and you don't always do it perfectly, is to be patient, to be disciplined, to recognize that opportunities take time often to come to fruition. But I tell you what, when I was a younger investor and you're watching every second of every move of every stock and every bond, you can't help but succumb to short-term thinking. So if you think long-term and you act long-term, our view is that'll be rewarded. But there's a real discipline that is necessary to do that.
I love that idea of abstracting away from that and zooming out of the day-to-day noise and focusing on what's important. Well, this has been heaps of fun, Dion. It's the first time we've met, but hopefully, given our proximity to one another, it won't be the last time. Well done and congratulations to you and the team on the business over these 7 years, I think you said. To get to where you are is pretty incredible. So, to say the least. So thanks for sharing some of your wisdom with us and appreciate you taking the time.
Wonderful. Thanks for taking the time, Owen.
Thanks for watching this video on the RAS Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.